Every single company out there, I don't care if it's a tiny startup or a massive global corporation, is basically living a double life. Seriously. There's the value it has as a living, breathing business, making stuff and earning profits. But then there's this other, shadow value, what it would be worth if the lights went out for good tomorrow. And that right there is the big question we're tackling in this explainer. Forget the stock price for a second. Forget all the hype. If a company actually fails, what's left? What's the real, tangible value of all the pieces? It's a fascinating puzzle, and we're going to solve it together. So, here's the thing you have to get. We're talking about two totally different ways of looking at the world. On one side, you've got the going concern value. That's the optimistic view, right? It's what a company's worth because it's alive and has a future. But on the other side, you've got liquidation value. This is the hardcore pessimistic view. It's the scrap heap value if everything just stopped. And that's where we're going to start our investigation. To figure out what a company is worth when it's dead, we first have to understand how it's valued on paper while it's still alive. So let's pull back the first layer and look at the accountant's version of the story. It all starts with something called book value. The formula itself is actually beautiful in its simplicity. What you own minus what you owe. That's it. The number you get is the company's book value, its official net worth on the record books. In theory, this is what shareholders would get if the company sold everything at its recorded price and paid off all its debts. But, and this is a huge but, there's a catch. And here is that catch. It's called the historical cost principle. What that means is that accountants record an asset, a building, a machine, whatever, at the price it was bought for, maybe years or even decades ago. It's basically a snapshot frozen in time, and it doesn't always reflect what's happening in the real world today. And this just shows you the problem perfectly. Think about a factory bought back in 1980. On the books, after decades of depreciation, it might be worth next to nothing. But what if it's in a neighborhood that's now a super hot real estate market? Its real-world value could be massive. On the flip side, you could have a 5-year-old piece of tech that still looks pretty valuable on the balance sheet, but if a newer, better model just came out, its actual resale value could be practically zero. See, the book value gets out of sync with reality fast. Okay. So we've established that the official book value can be, well, a little sketchy. So how does the stock market, the collective wisdom of millions of investors, deal with this? Let's move from the accountant's quiet ledger to the loud, chaotic opinion of the market. Investors have a tool for this. It's the key metric, the price-to-book ratio, or P/B. It's incredibly simple but tells you so much. All it asks is, for every $1 of net assets the company says it has, how many dollars are investors willing to pay to own a piece of it? Now, how you read this number is where it gets really interesting. If the P to B is over 1, the market is basically saying, we see potential here that isn't on the balance sheet. A great brand, smart people, something. But when the P to B is under 1, that's where it gets tricky. Is it a screaming bargain, a company whose physical assets are worth more than its stock price? Or could it be a value trap, a signal from the market that those assets on the books aren't really worth what the accountants are telling us? And this is exactly why context is everything. Just like at the tech sector, a PB ratio over 13. The market is shouting that for a tech company, its physical stuff, its offices, its computers, is almost irrelevant. The real value is the code, the brand, the data, stuff that barely shows up on a balance sheet. But then, look at a bank or an energy company. Their whole business is built on tangible things like loan portfolios or oil in the ground. For them, the PB ratio is much lower and way, way more meaningful. All right, so we've heard the accountant's story, we've heard the market's opinion. Now it's time to get to the absolute heart of the matter. We are peeling back every single layer of hope and future promises to find the rock bottom, the hard, cold liquidation value. To do this, we have to split a company's assets into two totally different buckets. You've got your tangible assets. That's the stuff you can literally touch: cash, buildings, inventory. And then you've got intangible assets, the ideas, the brand, the patents. And let me tell you, in a fire sale, that distinction is everything. This leads analysts to a much more cynical, but maybe more realistic calculation: tangible book value. The adjustment is simple, but it is brutal. You take that regular book value formula and you just toss out all the intangible stuff, especially this thing called goodwill, which is just a phantom number from past acquisitions. What's left is the value of a company propped up only by its physical things. But even then, not all tangible assets are created equal when disaster strikes. This is where the idea of recovery rates comes in. It's basically the percentage of an asset's book value you can actually expect to get in your pocket during a forced sale. And as you can see, these numbers are all over the place. So let's start with the undisputed king of all assets in a crisis, cash. Its recovery rate? 100%, always. There's no discount, no haggling. A dollar is a dollar, and when everything is falling apart, it's the most beautiful thing a company can have. Okay, now look at inventory. All of a sudden, we're taking a massive haircut. That warehouse packed with last season's fashion or slightly outdated electronics, you'd be lucky to get 50 cents on the dollar. You have to sell it now, and that means deep discounts. And here it is, the most brutal, most painful number of them all, goodwill. This number can represent billions of dollars on a balance sheet, and in a liquidation, it is worth precisely zero, nothing. It represents the hopes and dreams of a living company. When that company dies, goodwill vanishes into thin air. So the company's assets have been sold off, probably for pennies on the dollar. We've got a pile of cash. Now what? Well, now comes the final painful question. Who gets paid? And this is not a free-for-all. It's a very rigid, very harsh legal process. It's called the absolute priority rule, but people in the business call it the bankruptcy waterfall. Think of it like that. The money flows from the top down. First, the secured creditors, like the bank that has a mortgage on the headquarters, they get their money. Then the lawyers and the accountants running the whole show get their fees. Way down at the bottom, last in line, are the common shareholders. And in most liquidations, the water runs completely dry long before it ever gets to them. You know, this whole process we've just walked through, from book value all the way down to liquidation, it was built for an economy of factories and machines. But what happens now, when the most valuable things a company owns are completely invisible? Let's look at the huge challenge facing us right now. Just look at this number, 90%. That is absolutely staggering. In today's economy, that's roughly how much of the value of our biggest companies isn't in their buildings or their machines. It's in their data, their software, their brand reputation, and the skills of their people, all assets that traditional accounting pretty much ignores. So this is a whole new frontier of valuation. Analysts aren't just looking at the balance sheet anymore. They're trying to put a real price tag on a company's data by looking at the income it produces. They're starting to treat skilled employees like a critical asset, tracking things like retention rates to judge a company's health. The old rules are literally being rewritten as we speak. And that brings us right back to our central mystery, but with a crazy modern twist. For 100 years, we've tried to find a company's real value by looking at the stuff we could touch and count. But in an economy where the most valuable assets are completely invisible, what does real even mean anymore? That's the question that's going to define finance for the next generation.